I'm in Northville. So
Okay.
I have been in Northville since the middle of March. Actually, the last time I think I was outside of Northville, I saw John at dinner in Ann Arbor.
Yeah, that's
But
right.
they
That was
have been locked in ever since here in Northville.
So where did you go to dinner in Ann Arbor?
Oh, some Korean barbecue.
yeah, Soul Kitchen.
Was it open?
You know, it was probably close to closing down when
So
we
pre-lockdown.
were there. There weren't many people there. That was probably around the 12th of March that we met there. So yeah.
Yeah, something that Stephen Sherman had set up.
Yeah.
And we figured, because the Koreans seem to be doing the best, even right now, still in handling this COVID. So why not go to a Korean restaurant?
So you felt safe.
Yeah, we felt safe. So we had a couple beers to wash away any of the virus, so it was good.
Yeah.
That's my theory.
Uh-huh.
Yeah.
Drink Coronas.
Yeah.
I would, except that I can't stand that beer.
Right.
This is Autoline After Hours with John McElroy and Gary Vasilash, episode 509 for May 14th of 2020, reopening the auto industry, challenges, and the aftermath. Watch Autoline After Hours live at Autoline.tv every Thursday at 3 p.m. Eastern Time. That's 12 p.m. Pacific. You can subscribe to this podcast for free by searching for Autoline in iTunes, Stitcher, or YouTube.
Autoline After Hours is brought to you by Bridgestone Tires. Your journey, our passion.
Hey, Gary, how's your cabin fever going?
Oh, it's not bad. It's what are you gonna do, right?
Yeah, no, I think everybody's making the most of it, those that can. We're fortunate enough to have jobs where you can work remotely.
Absolutely.
The people I'm really feeling for are the ones who are living paycheck to paycheck and can't get to their job and, start earning a living again.
Right. Well, this too shall pass.
It shall.
So anyway, today in history was not a big day. I was really struggling to find something, but then I found something that was rather interesting about a guy who rode a 2-speed Indian motorcycle. He rode it from San Diego to New York. It took him 11 and a half days. Okay.
Wow.
The interesting part about this is the guy's name, E.G. Cannonball Baker.
Oh, no, kidding.
So in 1933, he was to do the run from New York to LA and set a record in 53 hours in 53 hours 0.5. And that stood for nearly 40 years. And that was where the Cannonball Run came from.
I never knew where they got that name from.
Yeah. So here he is. Just think about this. In 1909, riding this motorcycle, which looked to be approximately a bicycle with a power mower engine on it, 11 and a half days.
And you know what? That was probably faster than any car could do it, because with a bike, you can get through a lot easier where there's no roads and things like that.
I just can't imagine, though. I mean, it's just crazy. So anyway, we talked about the Cannonball Run, I think 3 weeks ago on the show. And here it is, lo and behold, E.G. Cannonball Baker.
That's cool. And what, he completed the trip today on this date or started it?
No, he completed it in 1909 on his Indian motorcycle.
Wow.
So crazy.
111 years ago. Amazing.
Mm-hmm.
Hey, we've got to let everybody know we got Jamie Butters here from Automotive News. Come on in, Jamie.
Hi, John. How are you?
Enthusiastic
as always.
Yeah, right. Where are you coming in from? At home, it looks like.
At home in Pleasant Ridge, Michigan, just north of Detroit.
Uh-huh. Good stuff. Hey, we're glad to have you on the show today.
And you're clean shaven, and we're about to see someone who is not clean shaven.
Okay, let's bring in our special guest, Paul Eichenberg.
Yes,
Oh yeah, he's got the virus beard going.
I do. So this is my first pandemic. I didn't live through the whole Hong Kong flu or Hong Kong fever back in the late 60s. So this is my pandemic beard.
This is mine, but
Yeah.
doesn't grow much. But, you know, Paul, we had you on because you're the guy who knows all about suppliers and supply chain and, you know, what's going on in the industry, what should be going on in the industry. And, you know, the last couple times we had you on, you were very specific in pointing out that some suppliers were going to have trouble surviving. Okay. And this was when times were good.
Right.
What do you see going on now, Paul?
Yeah, so actually, that's a great question. What I talked about the last time is if you looked at the OEMs last year, in 2019, they let 65,000 people go across the globe. And the main driver of that was electrification and digitalization of the business. And frankly, a number of those OEMs like General Motors, Daimler, VW have come out and said, well, we're stopping powertrain development going forward, and made those type of announcements. So what I expected coming into this year was start of a trickle down through the supply base as that activity stops at the OEM. It was going to impact the supply base. And then COVID-19 hit. And to be honest, I think we are on the verge of probably the worst bankruptcies, especially in the tier base, the supplier base, than what we've ever seen. It's going to rival what, it's going to be twice as bad as what we saw back in 2008 and 2009, just because of the differences that are associated with the shutdown that we've had over the past 8 weeks.
So does this predicated on the technology change or just the business conditions?
Yeah, I think first of all, so there's a couple of things that are here hitting at the same time. First of all, you have structural changes, huge structural changes going on in the industry as a result of the technology disruptions and CASE. So I think what you have is you have these type of structural changes. Now you start to move into this whole issue associated with moving from global back to local, which is a significant trend that we see. I mean, there's just countless structural issues that are hitting. And then, frankly, what we're in right now is a liquidity crisis that's really as a result of the stop of production for 2 months, not only here in North America, but you have that in Europe. You have had that in Asia. So as a result, if you think about just a North American supplier, for instance, you've had 60 days of complete shutdown of the industry. And the interesting thing is when everybody starts up next Monday, the significance of that is the OEMs pay on 60-day terms. So basically what you've had in the midst of this crisis is everybody's still getting paid. What happens Monday when the launches restart? Nobody has income for 60 days. And this is the issue that I think is going to really cascade through the supply base, not just here in North America, but it's happening globally. And what you have is this time frame between Europe and North America basically starting up again as a result of this 60-day shutdown. And the question is how do you bridge the gap from really Monday to being able to start collecting receivables again from the OEM? How you cover that gap is significant, along with, on top of that, just 60 days of income that really our industry is not set up to handle.
Yeah, Paul, I had heard that GM had moved to 45 days, which still isn't all that great. And I also heard that automakers will pay you quickly, like right now, but you've got to agree to a 5% pay cut or, cost cut, price cut. And, margins are already paper thin. You take 5% out, now you're losing money.
Yeah, so I think there's a number of activities like this that are out there that are going. I would tell you, I was just talking a couple of days ago to a tier 2 company that basically all the big tiered suppliers had virtually shut them off, so it stopped making payments to preserve cash on their own. So I think when the industry starts back up Monday, what you're going to see is this incredible reckoning. The reckoning that you're going to have is all the suppliers who didn't get paid are going to take the attitude, hey, we're not shipping until you make us whole, because everybody's going to be on this very, very tight line. And as a matter of fact, I've even talked to some well-capitalized suppliers that have said, hey, you know what, we're well-capitalized, but when we have to file our covenant certificates with the bank come the end of the quarter, everybody's going to be in violation of their covenants. So I think what we're, again, going to see here over the next 45, 60 days is sort of how the industry works through this. The other thing that I think is playing a big part of this is just the global supply chain. And specifically, what we've heard from a number of electronics companies is they buy a lot of their electronics coming out of Asia. And basically, considering the situation out of Asia and the trade war that's continuing, a lot of those suppliers have switched to pay on deliver or pay on FOB Asia. So now you've got the time to get that over from Asia, where maybe you were on net 75 days. Now it's cash for delivery. And I think, again, these type of issues that are going to impact the supply chains both here and in Europe over the next 45, 60 days are going to be just a tremendous amount of chaos that organizations are going to be working through.
Paul, do you see this mostly being a North America phenomenon, or are there, I don't feel like we've heard a lot about smaller Chinese suppliers going bankrupt, or maybe that just doesn't, the word doesn't get out. Do you see a geographic pattern to this, or really global?
Yeah, I would say, again, and I think some, governments intervene in different ways. So, spending a year in China, I can tell you, again, employment is seen very differently. Bankruptcy, these type of financial situations are just handled in a very different manner than what we do traditionally in the West. If you look at Europe, I think Europe is, again, a little different system than what we see here. But again, just give you, for instance, there's a company here that's based here. They have a large presence here in the U.S., but they're a French company by the name of Novaris, and they are an organization that's based in France. Last Monday, they filed for bankruptcy or Chapter 11 in France, which has an impact on their business here. It has a impact on their business around the world. You may know them as part of what was rolled up into them was Key Plastics. Miniature Precision Components is another part of that roll up. But here's a business at the front end of the situation that finds itself in a bankruptcy. That was last Monday. So again, I don't think it's going to be just here in North America. I think we're going to see this phenomenon around the globe, and it's really going to be a question of how do governments intervene. I think one of the things that's important to know, if we look at the last financial crisis, the only ones who got bailouts in that situation were the big OEMs. It was GM, and it was FCA. Now, today, it looks like the bailouts are going much more to Main Street, smaller businesses with less than 500 employees. So to be honest, most suppliers will not be able to get that type of stimulus or that type of bailout support. And I think when you read the political, wins that we have here, the idea of bailing out big companies is not good for either party. So the fact of the matter is when it comes to this type of situation, I think what you're going to see is like what Adient did a couple weeks ago. So Adient went out and raised $500 million of new debt. You're going to see the larger companies are going to be able to go out and get bonds and basically, get the debt financing that they need to cover this gap as we see it today. However, the mid-tier companies, the $500 million, $1 billion type of companies and smaller, they're going to have a real hard time finding the right type of financing to get them through this next 60, 90 days.
So Paul, I mean, for those who are not familiar with the way that the industry works, so you have these smaller suppliers that feed up to another tier, which go to another tier, and then the tier one supplies the OEM. If a supplier down here that makes springs or brackets or something that we just don't think about, but what are essential to the higher levels, I mean, how can the industry restart?
Right. Well, I mean, if you think about it, just the internal combustion engine has 500 parts, and you start thinking about that and you're talking about fasteners, you're talking about springs like you are, number of die cast components, you name it. There's 500 parts that go in that system to make an engine and make a vehicle run. You've got somebody in there that's in distress, it's multiple tiers that do not operate. So that's why I say I think we are at the verge here of, the last show I was on, it was called Carmageddon. Times are much more difficult now as a result of this supply chain that's really got to restart. And the fact of the matter is every organization shuts down for a couple of weeks. This has been 2 months. There is going to be a working capital cost to restart value chains like the industry has never seen. And again, I don't think that can be underestimated at this point in time. So, you talk to any of the restructuring firms and they'll tell you the past 12 weeks, they've seen more distressed activity in the past 12 weeks than what they have in careers. So the fact of the matter is we need to be prepared that over the next, 45, 60 days, as this thing ramps back up, chaos is going to ensue and there's going to be a tremendous liquidity crisis that's going to come as a result.
So Paul, what do you think is going to happen? Are the OEMs going to step in on a chosen basis where they've got to get somebody going? Do you think governments are going to step in?
Yeah.
And lastly, one company's disaster is another company's opportunity. I would expect the venture capitalists to go in and say, hey, we can buy up this auto industry for pennies on the dollar.
Absolutely. Absolutely. As a matter of fact, some of the bankruptcies that I've heard is just because the banks want out of the situation and they don't want to have to plow more cash into the industry and into these businesses. Basically, they're walking away and a starting point is saying, hey, 50 cents on the dollar, somebody come in, buy the debt and move forward. And I think, Dura Automotive just came out of bankruptcy, and it's rumored that basically Chris Charlton has led that effort and basically has come in and taken over Dura for the debt he already has in the business. So I think, you're going to see this type of activity taking place. I think now is a time you're going to see private equity firms come in a big way. They're traditional buyers of this type of debt. This type of equity we're going to see in the industry for sure. But to be honest, not every bank's going to be able to walk away from every asset they have. So banks are also going to be a big part of this in deciding, okay, which of these businesses do we consider, continue to feed? And I think that's the real challenge for businesses at this point in time is you've got really 3 new type of constituents that you have to sell on the viability of your business going forward. That's the banks, that's investors, and that's your customer. And the fact of the matter is I understand from organizations like General Motors and a lot of the OEMs, they're already saying, hey, don't come to us. They're already pushing back on the big tiers. Don't bring your problems to us. You make those sourcing decisions. You handle this. But as we're talking about, as you start looking at ecosystems, and as Gary talked about earlier, a spring that goes into a transmission, an automatic transmission, there could be an organization that's producing that, a spring. There's very few of those type of suppliers for automatic transmissions. What options are you going to have other than helping those organizations through this? And basically, OEMs are going to push down on the guys that make the critical transmission components like Magna and ZF and Borg Warner, and they're going to push. But in the end, they may have to come in and support this activity also. So it's really going to go across this spectrum, which I think is going to be something that's really, like I said, is really going to be playing out here over the next 45 to 60 days.
So Paul, you provided us with some slides. Let's go through some.
Yeah.
I think that.
Yeah. So
to what you're talking about.
Yeah. So let's put up the first slide. I think the first slide is something that's really critical to understand. So the first slide that we have here is really starting to talk about a period of great uncertainty. And the issue that we have here is I can go back to 1980, and I can tell you the average recession that we have is somewhere between 6 months and 18 months in the automotive industry. This is a very different event because it's a medical crisis, first of all, that's leading to a financial crisis. And what we see here is, we already started to see a dip in the industry, but frankly, what we're seeing now is this period of tremendous uncertainty, because the question is what can we expect, or when can we expect to have a vaccine and the ability to return back to normal? And the fact of the matter is your guess is as good as anyone's at this point in time. So what we see here are three scenarios that are starting to emerge in the industry. And what I would tell you is we talk to suppliers, as we talk to forecasters, as we talk to a number of different participants in the industry, most everybody is very optimistic at this point in time. Now, I know a lot of people are as scared as hell, but the fact of the matter is when you look at the forecast, a lot of people are favoring the green line versus the other lines. And I think there's two things that organizations really have to be focused on at this point in time. First of all, you have to start developing multiple scenarios, because history tells us when you have this type of pandemic, you have a first wave and the second wave's worse. So the fact of the matter is come the fall, we may be back into a situation where social distance, labor, nobody's going to want to continue to work in that environment, and we may be in another shutdown later this year. And the fact of the matter is nobody can forecast that at this point in time. Like I said, it's anybody's guess. So the fact of the matter is one of the things you're really going to want to start to do is be able to put together a number of scenarios to say, okay, what do we do if? What do we do if? These are the organizations that are going to be best prepared, and they're going to be the ones that make the best arguments to the banks, the customers, and the investors as far as they're going to be all right as they work through this. The other thing that I think is really somewhat overlooked, and of course, being a strategist, the one thing is with this period of uncertainty for the next 3 to 5 years, the most solid thing that you can go back to is to sell everybody the fact that you've got a viable long-term strategy, that you are worth saving to get to that point of 2025 and beyond. This is so important for organizations to do right now, because a lot of what organizations have been doing is financial or cash management. They've ignored the fact, hey, we're working to something that's going to be providing better cash flow, better growth in the future. And that is the critical part of articulating your long-term strategy, again, to these key constituents, the customers, the OEM, or your customers, whether it's the OEM or the tiers, the banks, or your investors.
So, I mean, so what would be an example of something that a company could do to say, hey, we've got life ahead of us?
Yeah, yeah. So if you put up the second slide, I think that's one of the things that we've been working on is really this is what we refer to as our survivability funnel or our liquidity crisis model. And specifically, there's three things that are really critical for organizations to be articulating at this point in time. First of all, it's the financial activities as far as what's going on. So specifically, we saw immediately companies suspend dividends, stop capital payments, layoffs, furloughs, pay cuts, etc. We saw that activity. Now what we're just starting to get into is the operational activities. Now that we've stopped hemorrhaging cash, what can we do? And I think this is a tremendous opportunity for organizations, especially strong organizations, to go on the offensive. This is the time you attack your weak competitors. You secure your supply chain. You exit non-core or non-strategic business and customers. This type of portfolio pruning is going to be critical for organizations so that as they move into the final phase, which is going to be asked in these kind of conversations, is what's the long-term viable strategy that you have? So the ability to really articulate a vision and a winning position is critical, but then also talk about how you're reprioritizing the portfolio. And then ultimately, what are the strategic actions you're taking to create a winning long-term position in that future market? And I think this is really the critical piece that organizations have to work through as they're going through this. And articulating this message, again, not only to banks and investors, but your customer is really a critical action for these organizations to be taken at this point in time.
So, Paul, what's really scary is your first chart there really doesn't show the global industry recovering until around 2024, 2025.
Yes, it could recover faster. It could be slower. Again, like I said, that's anybody's guess at this point in time because we don't know how long this situation is going to last. So again, I think this is why we're moving into this period of great uncertainty. And what organizations have to do, like I said, it's not only controlling cash, but it's also then starting to understand, okay, what can we do to add more efficiencies? What can we do to make operational improvements? What can we do to stop pet projects or unnecessary programs with customers? And these type of things are going to be really critical at this point in time for organizations then to be able to articulate, hey, this is why I'm viable at the end of this crisis, and this is why I'm worth saving.
So, Paul, what's happening right now operationally? The Michigan is allowed to operate again. The Detroit 3 plants, and I guess Tesla 2 are planning to resume a vehicle assembly next week. Will all of the parts that need to be delivered, will those start shipping into factories by Monday or Wednesday?
Yeah,
when they have their systems figured out? And
yeah, Jamie, I think, first of all, that's a great question. I think, like I said, it's unknown at this point in time. There were some organizations that wanted to go back 2 weeks ago, and then they got the order to stay home for another couple of weeks. I think, again, like I said, we've talked to some suppliers that haven't been paid for 45 days, okay? And you know what? I'm not shipping because if the OEMs want to get mad, they're going to get mad at my tier one. They're not going to get mad at me, okay? So this is all being worked out probably around the clock as we speak right now. What happens on Monday? Well, I think, to be honest, you're going to start to see a situation like we talked about with Novartis, okay? You're going to see some people are just going to be limping along and saying, well, who's going to help me? Am I going to find a customer who's going to give me a bridge loan? Am I going to find somebody here? And frankly, what's going to happen is they're going to limp along to the point where they say no mas, and frankly, move forward from there. So I think, again, we are on the verge of a chaos as a result of this startup. because of what's happened over the past several weeks. And I think the other thing is labor. I've talked to not per se UAW organizations, but I've talked to a number of organizations where employees are being paid more to be on unemployment than they are going back to work. Okay, so the fact of the matter is you've got to get those people back in the factories to start these things back up. They've got to be willing to go back. I remember talking to a company that laid off a bunch of shop floor workers, and I remember the guy running the floor. He said, "I've never seen people so happy to be laid off." Okay, because of their own personal health conditions, the uncertainty at that stage of time, just all these different things. So it's not simple issues. These are complex issues for organizations to be able to build back these supply chains. And I think the investment, again, that's going to be required to start this is just something that organizations haven't really been planning for. I mean, I'll give you another example of a tier one that I talked to just earlier this week. So they furloughed employees on Mondays and Fridays. They have a series of major launches here in 6 weeks that basically are trying to figure out how do we launch this with a third less workforce. Because you know what everybody's doing in their organization because they're not getting paid? They're not working 2 days a week. Okay? And the fact of the matter is they keep raising their hands. Our programs are red, our programs are red, our programs are red. Everybody's taking Monday and Friday off. Okay? This is the culture you have in some suppliers. There's other suppliers we talk to. They've been furloughed once a week. Everybody's working. Everybody's working. They've got commitments. And frankly, as an organization, they're there to deliver results, and they're going to follow through on their commitments. So again, you have so many issues that are playing here with this supply base to be able to, drive the industry forward. And that's why I say I don't think we've seen all of the issues that are going to be coming out of this. And even the other thing is Mexico. Mexico is just like here. The governors of the states are going to decide who goes back when. Okay, if you know anything about working in Mexico, some of them are going to say, "Well, who's going to pay? Who's going to make it worth our time to go back?" So the fact of the matter is there are just a tremendous number of issues associated with this that I think we all have to acknowledge. It's going to take some time to ramp this thing back up.
Yeah, a lot of serious things to think about there. And we've got to take a quick commercial break right now. Paul, can you stick around?
Absolutely.
I know Gary's got other topics that we want to get into, and we'd love to have you on board for that.
Okay.
But good deal. So right now we're going to give a shout out to our good friends at Bridgestone. All right, we're back talking about all things automotive, and I believe we have a number, don't we? Dr. Data, let's hear it.
We do have a number. So Paul is familiar with this. We've done the number before, and Jamie is completely unfamiliar with this, so I have to tell you what this is. So I am going to have you guys, I don't want to say guess because, you guys are all really smart, so you'll be able to discern, calculate, and assess what the number is that I'm looking for. Okay, so this one's really easy, and I'm sure that you'll all get it. So Katie, please bring up the first slide. All right, so in 2018, the average US household, which was $60,000 then, spent 32.8% of its earnings on housing, 13.9% on food, 8.1% on healthcare. I want you to tell me what the percentage is in terms of transportation, and you can't cheat and say, well, gee whiz, I'll just add up those other numbers and come up, what's to 100, because there are other factors that I have not shown you. So I will begin to ask you what you guys think this is.
It's 12 to 15%.
Wow.
Yeah, I was going to say 15.
Jamie?
I'm worried about how transportation is defined, and maybe all in it is that bit much. I feel like have seen numbers as low as like 5% or so. No, more than healthcare. That's good.
No. You said 5%?
No, so you're saying it's more. If it's more like they're saying, people are spending more on transportation than healthcare, I guess that's out of their take-home pay, not including what their employer pays for them. I was thinking it had to be less than healthcare, which is such a big part of the economy.
It has to be more than 5%.
Yeah.
All right. Katie?
There you go.
Yeah.
So you guys were very good on that. So, and then this is how it's broken down this way, so you can see what the elements are. Katie. So there you see it. So a big whop to buy a purchase, and then you have these other factors that lay in there, and I think we're going to really see a big change in terms of that gas and oil number going forward.
Huh.
That ought to come down. That's right. Gas prices are a whole lot cheaper right now.
So before we move on to other things, I just want to tee off of this, Paul. You've been a big proponent of changes in terms of propulsion systems and saying that we're going to get to more of an electric future. Do you see any changes now? A, predicated on the collapse in oil prices, and B, predicated on OEMs saying, gee, we really have to, keep our monies closer, and we don't want to invest in things.
First of all, great question, Gary. So, Katie, if you'd go to slide 3, I was expecting at least Gary to bring this up. What we've done here is the previous slide that we shared was the idea of what are the different, what are the actions that organizations have to take. We did the same thing as we looked at the financial, the operational, and the strategic trends. And again, I started the conversation with the discussion that we had around the idea that there are huge structural changes going on in our industry. They're going to go on for the next 15 to 20 years as a result of all the technology disruption that we're having. And specifically, if you look at the last column, as far as what's the worsening situation, or how does the situation get worse, you see those across the top have had a significant impact as a result of the COVID-19. As we talked about globalization, as Gary, you just mentioned, the ability for OEMs to invest is a significant issue. And again, is forcing the OEMs to find new ways to collaborate. Ride sharing has taken a huge hit. Because nobody wants to get in a car with an Uber driver that they don't know. However, if you look down the list, micro mobility has grown like crazy. This is Uber scooter program and these type of things that you see, bike rentals in cities. At the same time, you see robo-taxis is even a bigger desire as a result of this situation, because people will get into vehicles as long as they don't have a driver in those situations. So we see a number of these trends. What you'll see right there in the middle is it's really yet to be determined what's going to happen with EV growth. Specifically, there's two sides of the equation that I can talk to. One, you're seeing an increase in regulation associated with green spaces. So there's a number of large cities that have converted roads to passenger streets for those bicycles and those scooters I talked about earlier. At the same time, with the financial crisis, we believe the OEMs are going to favor large SUVs and vehicles they make a lot of profitability on as gas prices are lower. So I think it's really yet to be determined what kind of impact there's going to be specifically for EVs, but you're going to see a number of these long-term trends are going to be significantly impacted as a result of COVID-19.
So it's interesting. So to give Jamie's publication a plug, Automotive News, I was watching the Automotive News webinar today, and a guy from PwC,
Dietmar Osterman.
Osterman. He said unequivocally that he thought that electric propulsion systems were gonna just dominate. That the argument being that the OEMs would not be able to afford to have a portfolio of different types of propulsion systems, and that given the global move towards electrification, that there would be a greater emphasis. I would have thought that it might have been just the opposite. They would say, well, you know what, we got some time. We'll just make those big SUVs that you mentioned they make a lot of money off of, and after we get a lot of money recouped, then we'll think about that stuff.
Yeah, if I can just comment on that, I agree. I think what you're going to find is, as I've laid out on that chart, what's the immediate impact of COVID-19? However, the OEMs are going to have to continue to invest. As I'm sure I've shared on this show, basically at the end of the decade, Europe is going to be at 59 grams per kilometer of CO2, which is the equivalent of over 90 miles per gallon for those of us here in North America. Specifically, there's only one way you get there: a large electrified fleet. Now, again, some interesting data out of Europe, specifically the first quarter of the year, where they were under the new legislation that was put in place at the beginning of the year to go to 100 grams per kilometer of CO2. There was already, Europe had overtaken China for more electric vehicle sales in the first quarter. And what you saw were very strong results for electric vehicles in Europe, even despite the crisis, much better than you did see in standard vehicles. So again, I tend to agree, but is that COVID related? COVID related is one thing to be seen versus what legislation is doing today, which is, frankly, I don't see changing as a result of this crisis. I see short-term implications, but long-term, I would agree with what Dietmar talks about.
So I want to ask you guys something before we move on to newsy items. And Monday, as you were talking about earlier, Paul, the companies are supposed to start building vehicles again. And, there seems to be a whole lot of focus on, ramping up production. So to the three of you, what is your sense of what demand is going to be? What are consumers going to be doing in the next several months? Are they going to be going to their local car dealers and buying vehicles? Or is it going to be a case where, the OEMs are going to be building cars and they're going to be parking them on lots somewhere? What do you think? All of you.
I'll plunge in and you guys can tell me how wrong you think I am, but I don't think there's a lot of people who want to go to dealerships. And there's also a lot of people who are insecure and not interested in making a big purchase, even though there's some really nice incentives out there. I think there are people whose leases are expiring will be in the market, and they'll do whatever they can do efficiently. But there could be some pent-up demand a little bit from the 2 months of not being able to sell cars. But it sure seems like we're going to be looking at, such a slower rate. Maybe 9 was the bottom point, but we're going to be running closer to 10 and 12 than 15 and 16 for several months.
Mm-hmm. Yeah, I think one of the things that you recognize is zero financing for 74 months. Mm-hmm. Okay, so this is
84 for a while, and some are starting to dial back to.
Yeah. So exactly. So you start thinking about this. This is a situation where 7 years of free financing to get somebody into a vehicle. Again, this is just a signal as far as what the OEMs are going to do. I think we all recognize the OEMs are going to be dropping the price because the cost associated or the fixed cost of running their operations are so significant. That they've got to get volume back into the pipeline. I think, again, you're going to see this as far as this rush to sort of bring this back up, but then we won't see what the long-term economic impact of this is going to be again for another 6-8 weeks, I believe, as far as, record employment, et cetera. So I think, it's hard to say what's going to come out of this, but definitely you can imagine the OEMs are going to incentivize these things in a significant manner.
John?
Yeah, I'm more optimistic with several asterisks. Number one is car sales didn't fall nearly as much as we thought they would in the U.S. in April. The drop-off was far less than what it was in China or in Europe. Moreover, we're seeing very strong sales in China right now, above what they were a year ago. Now, that's a bit of an unfair comparison in the sense that a year ago, sales were really down in China. Nonetheless, they're better than they were a year ago.
Mm-hmm.
And AutoNation, the largest retailer of automobiles in the U.S., in their first quarter report said they saw significant improvements in sales and activity at their dealerships in the last half of April. So I think we're going to see a snap back in car sales quite quick, as long as the automakers and suppliers are able to overcome some of the issues that you were talking about earlier, Paul, and they can actually manufacture these things. But my fear is that we come back very quickly to what, let's say 70%, 80% of what had been going on before. And everyone thinks, hey, it's over. That's it. And that's where I see the real danger happening is, look, people who can afford a new car all are part of households that make over $100,000 a year. They're overwhelmingly the kind of people who can work at home and presumably have not been laid off or furloughed. So I think those people can come back into the market very quickly. But look at what's happening with the daily rental companies. They are out of the picture completely. Hertz is probably going to go bankrupt in another month or so, maybe less. And the daily rentals buy 2 million vehicles a year. That's out completely. So that's why I'm saying I think some part of the market is going to snap back very quickly, and we're all going to declare victory and then realize that there's 25, 30% of the market that's not coming back anytime soon.
Yeah.
So, Paul,
and that's a deep recession in the industry, right? A 20 or 30% drop. We're still, when we come back, when things are good, when things are better, they're going to be depression level, deep recession stuff where we're looking at the cost cutting and the bankruptcies of suppliers and all that.
So Paul, with the 20 to 25% decrease, I mean, what does that do to what you were saying about how they want to, get the pipeline going and they get the volume? I mean, is that sufficient for them to be able to make any money?
Well, I think, again, you look at this already, you have 2 months of no production. You look at that across the year for the organizations, that's nothing that's coming back. Okay. Plus, what really John was talking about is the slowdown that's going to come now financially. So you're talking about, on top of that, you're talking about rental fleets, like John said, here in North America, that's 2 million vehicles. That's not necessarily considered in this for suppliers and others in the value chain. So again, I think this is why you have to step back. I want to be optimistic. And as a matter of fact, you look at LMC, you look at IHS, they're tending to be at the optimistic sides of those equations. And frankly, everyone I talk to, that's where they're planning for. Okay. But the fact of the matter is now's the time to say, okay, are we headed for a Carmageddon? And if so, how do we have to handle the next phase of this crisis? Because articulating that to the banks is going to be really critical, because some banks are just going to say, we've already got too much into this. Okay. So the fact of the matter is I think you need to look at this. This is a medical crisis phrase. We're getting ready to move into the financial crisis phase of this. And it's as a result of that employment, it's in the structural changes that you've had because there's no rental fleets, there's nobody traveling, okay? I mean, I've heard from a large tier 1 here that has multiple offices around Detroit. Just to give you, for instance, they have several facilities that they're leasing, their leases are up later this year. Guess what they're doing? They're consolidating people into office space. Okay. There are structural changes that are going to take in our industry as a result of just what's happened over the past 2 months. That's going to have an impact. Same thing's going to happen on the forecast side of things. And we're just, again, getting to that point where we're going to see those ripple effects as a result of no corporate travel, limited transportation needs when it comes to people visiting new cities, et cetera. So I think this is what we can expect. The financial crisis side of it is yet to come.
All right, so let's lighten things up a little bit and talk about one of our favorite subjects, Elon Musk.
Okay.
So he apparently, took to Twitter as is his wont and basically threatened the state of California that he would take his plant out of Fremont and move it to Texas or possibly Nevada. So what do you guys think? Is this real, or is this was Elon smoking with Joe Rogan? I mean, what was going on here?
I think it's very real. But, look at what he said. They were going to move their headquarters to Texas and all the other work that they're doing on. And he said they'd keep Fremont running depending on how the state treats them. Well, you guys all know you can't just pack up a factory and move it. It's not like packing your travel bags. It takes a lot longer. But you could start moving a headquarters, your design, your engineering, all your staff functions, everything like that. You could move that fairly quickly. I think he's dead serious about this.
What do you think, Jamie?
I think you make the right distinction. He can move his headquarters if he stays in this war of words with local authorities. He could totally move the headquarters. It'd be easy to do. It's really wherever he wants to put his desk and call his headquarters, put a PO box. I mean, look at Fiat Chrysler. You can choose to domicile kind of wherever you want these days. Moving the actual tech staff, they are landlocked there in Palo Alto, but Silicon Valley is such a part of their culture and their identity. It would be a challenge for the brand to do much more than that. But if he wants to move his tax headquarters to Nevada, it's not going to matter. Playing footsie with Texas does risk alienating the Californians, who are still his biggest market. Now he's growing bigger than that, and you're totally right. Fremont's not going anywhere. As soon as he can build a fifth factory, maybe he will build one someplace else, and maybe when the next recession comes, he'll close Fremont or something. But he needs to make every car he can make, and he needs Fremont running all their lines indoors and outdoors.
I'll bet he's looking at Toyota, which went through the exact same thing. They got very frustrated with the business climate in California. They packed up and left. And so many people said, it's really going to hurt them in California, the land of hybrids back then, at least, not so much EVs as it is right now. And they're going to lose so many people, and it's really going to hurt them. Sure, there were some hiccups along the way, but they made the transition with very few problems. They didn't lose that many people. They didn't lose that many customers in California. I think Elon's looking at that, and I think there could be something else going on here too. Elon knows his customer base is all the left-leaning, quiche-eating, blue state liberals. That's what he's got.
I thought Henry had a Tesla. Come on.
Well, there's a few outliers, and Henry's one of them. But now he's got Donald Trump praising him. He's talking about moving to the Lone Star State. And now, if you look on all the conservative commentary, Elon's a hero. So maybe he's thinking, you know what? I've already got a given customer base. Now I can go out and get all the red state, redneck, red meat eating conservatives cheering for Tesla and want to go. And by the way, it's an all-American company. So I think this kind of talk, he's not going to lose his customer base. I mean, they're all in, right? Even if he goes and plays footsie with Trump, they're not going to leave him because of that. And now he's opened up the possibility of attracting a whole new customer base.
Yeah, I thought, Gary, when you mentioned Tesla, there's two things that I would say have been really interesting in the news that I've seen just here over the past couple of days. It's not about this issue, but specifically You've probably read about the secret meeting that took place over in Europe between Daimler, BMW, and VW, in which they openly acknowledge they're getting their butts handed to them by Tesla on the operating system and the software that they have coming out of these new vehicles. They recognize that they are significantly behind. And in this time of crisis, like what we were talking about earlier, what are they trying to do? They're trying to pool their efforts together to start to create an operating system that's going to rival what Tesla's doing. So that's one thing I saw that was really interesting in the news. The other thing is, if you saw the article from Paul Leinart today, talking about Tesla, where they've achieved their battery technology. In the article, what they say that Tesla is going to talk about when they have their battery investor day later in the month, that at the pack level, they've achieved $80 per kilowatt hour, and at the cell level, less than $60. And let me tell you, this is a huge breakthrough in this industry. That in itself is a solid business case for the market to say the EV is cheaper than the internal combustion engine. So I would say, for me, that's far more interesting news as far as what that's going to mean for the industry versus where the headquarters of Tesla is going to be.
Wow, Paul, I had not seen that. Paul Leinart came out with that today. I got to see that. Yeah. That is a sensational number. That is unbelievable. $80 at the pack level is mind-blowingly good.
Yes. So actually, again, Tesla is partnering with CATL in China. This is the chemistry that CATL and Tesla have developed with no cobalt. So what will be interesting is at that price level, what kind of range and performance do they get from those vehicles? So if you go back to what GM's talking about less than $100 at a 400 mile range. So we'll see where Tesla comes in compared to that benchmark that GM has set.
Yeah, presumably if you take cobalt out, you're not going to have as much efficiency. The trade-off is, as you're pointing out, though, is the cost.
Right.
And for a lot of consumers, 400 miles, maybe they don't feel they need that, as long as they can get an electric car at a much lower price.
Right.
All right. So now a completely recreational subject, motor racing. So I thought there were a couple of interesting things that happened, and I know that, John, you're a big fan of Le Mans racing, and the Chevy team racing the C8 Corvette said, can't do it this year. Now, the Le Mans has been postponed until September from its time in June. So, and then Porsche has basically said, well, we had 4 factory teams, we'll have 2. So what's going on here, John?
Well, interestingly, Stephen Cole Smith, who I've got the greatest respect for, he's one of the best motorsports reporters out there, really knows what he's talking about, floated the theory that one of the reasons that Corvette Racing decided not to go to Le Mans is the C8, it's just not got the power. I mean, it's raced in 2 races right now. No, I guess 1. They were at Daytona. Sebring, I guess, didn't happen, but it was real slow. Or I guess it did happen at Sebring. But anyway, I'm getting all tied up with what race. It doesn't matter. Anyway, Mark Royce, he was pissed off about this. That's the only way to put it. And what Mark pointed out is that even with the delay, the team going over to France would have to quarantine for 14 days before they could go out and about and doing anything. And then coming back to the States would have to quarantine for another 14 days. And that's what he says made the decision for him. They're just not going to go to Le Mans. That's an incredible burden to put on the team members. And as you know, it's not just a handful of people that go over there. It's a boatload of people that go over for Corvette racing. They spend the entire month there getting ready for the race. So I tend to think more of what Mark Royce said of the logistical nightmare it would have been for the team to try to do this versus, the C8 just being down on power.
Well, I did read some of those numbers though, and it seems to be down on power too. So.
Oh, it is. There's no question. I'm sure that Corvette Racing, General Motors, and Mark Reuss are very disappointed that this thing wasn't a whole lot faster right out of the box. But hey, it isn't easy to develop an all new car and expect to bring it right up to the level of everybody who's got cars that have been racing all along. So I kind of understand what the issue is, and on Mark Reuss's point. And besides, the only way you make a race car faster is you start putting it in more and more races and learning from that experience.
Okay, another racing question for you, John. Sebastian Vettel leaving Ferrari.
Yeah, big shocker. I mean, in the rarefied world of Formula One, especially at a Sebastian Vettel level, you make a boatload of money. I don't know exactly what the numbers are for him. He's probably making at least $40 million a year. And
it's like what you make, Jamie, right? Isn't that what Automotive News pays you?
That's only his bonus.
Oh,
Yeah, right.
I knew that. I knew the number did have some resonance.
Mm-hmm.
So we'll see. Look, Vettel is not the Vettel that he was of a few years ago. His performance over the last couple of seasons has been shockingly bad in a number of races. So I think Ferrari told him, hey, guess what? The young kid coming up, Charles Leclerc, he's going to be the number one, and you can stay on and we'll still pay you. And I think he just said, no, I'm out of here. I think he wants to go to some other team, and they'll be after him where he can be a number one driver. I don't know if that's really what went on behind the scenes. That's just sort of me, guessing at what happened.
So John, you mentioned, the young kid coming up. Vettel is 32.
I know. That's old in Formula One.
Up there.
Look, in most sports, your prime years are roughly 20 to 30 years old. And Sebastian still has a lot of wins left in him, possibly with the right team, even a championship. But
four-time world champion.
Yeah. He could win again, but it was a real shock in the motor racing world to hear that he's leaving Ferrari.
Mm-hmm. So, Jamie, what's been on your mind of late? I know we're coming to the end here, but I just wanted to, so what are you looking at or thinking about, or besides sheltering at home?
You mean work-wise? Entertainment, for sports, so there's no sports. I've been watching The Last Dance on ESPN about Michael Jordan and his Bulls. It's good to regain a little perspective on that team and his leadership and his excellence. That was fun. Doesn't have anything to do with work other than, leadership is leadership. That's always important.
Paul, what has been on your mind outside of this post-Carmageddon world that we're coming to?
So I would tell you, a blessing from this is my 8-year-old son is home. We're here, first time in my career. I haven't been spending tremendous time traveling. So every day I get an opportunity to go for a walk one-on-one with my son, just have that time. There is no, better outcome as a result of this than just having that opportunity to be with my son. So I got to tell you that between the projects that we're running, the work that we've got going on, that's my sanity and that's my escape, to have that time with my son.
That's
great. That's fantastic.
Mm-hmm.
Yeah.
That's a great age.
Yes.
So how about you, Gary? What are you thinking about these days?
I'm just looking forward to going to a restaurant. Okay. I mean, it's just, but then I think, when would that happen? I mean, it's just, so many things have to come together. And I think it's going to be, post-vaccine will be the most likely.
Yeah.
And you, John?
Well, I mean, I'm worried. I come back to what Paul was talking about earlier, but I'll talk on a macro view. If we don't do this right, we're dropping down into the Great Depression Part 2. And I just hope our political leaders have the fortitude to step up and do what's got to be done right now, not dilly-dally around, wait and see what's going to happen. This is a time for bold action, action like we've never seen it taken before. And I mean, my big fear is if we don't see that happen, we're heading into a world of hurt.
All right, so to get back to a serious question, I want to ask you guys. So, okay, Monday, people go back to work. Monday, people start filing into the factories. Okay, what happens, and I'm sure this will happen, what happens when the first several people working on the line get sick? Will everybody go back out again? Or will they just continue and hope for the best?
Look, some people are going to get sick. They are. I mean, this is just the nature of this virus. But China's been back to work for 2 months right now, and they followed all these protocols, and no one's gotten sick. GM and Ford have been making respirators and ventilators for a month and a half with UAW volunteers,
Right.
following very strict procedures. No one's gotten sick. Now, that doesn't mean that they can't go home and walk around the block and walk past a neighbor and catch something. But it sure looks like they're not going to get sick by going into these factories. And I think that the fact that we've got this track record now of a couple of months in China, about a month in Europe, maybe a little less than that, but about a month and a half for GM and Ford using UAW workers in their facilities making respirators and ventilators, tells me that's probably the way it's going to go.
Yeah, I talked with a European company that makes equipment for the automotive industry and a number of other industries. And they have a facility in China that never shut down. And basically, what they had in China was the equivalent of our OSHA. Basically, put out a set of guidelines. Here's the social distancing requirements. Everybody has to have access to plenty of masks, gloves, etc. They put that in place and never had to shut down an operation. And I think, as John was talking about, I think there's only been one death in the UAW as a result of working in a facility. Okay, so I think there is a track record here with distancing, etc., in the facilities that would lead us to believe it can be done. Everybody's going to have to be diligent. Everybody's going to have to be disciplined, etc. But I think it can be done, and I think that should be seen as a positive sign. So far, what's happened.
So, Paul, I think you're right, and John, you make the great point. It seems that it can be done by the OEMs. By the well-funded companies. I guess, Paul, do you feel confident that down in the tiers and some of these companies that are, fighting for survival, are they going to be taking the time and the effort, the care to make sure that their workplaces are far enough apart and that people have all the gear they need to not spread the germ?
Yeah, it's like what I was telling you about earlier. I think, these people in these facilities are not indentured servants. They are people that will make decisions. Am I going to go to work or not? Whether it's $12, $14, $16, whatever it is this going to be an environment for me to go back to? And frankly, if the company is struggling, okay, I think people, if the safety's not there, et cetera, people will make their own decisions. So I think I don't think we're going to see a time where, these lower tiers that are struggling to get by, I don't think that's going to be the issue. I think what the issue is going to be, are we going to get the funding to do what we need to do, versus forcing people to work in environment that's just not safe. That's my expectation.
If you're a supplier on the ropes and you've been paying $8 an hour, and now people are going to say, if I got to go to work in a factory and walk through the same door as 700 other people, you know what? I need $16 an hour. You're going to be out of business, right?
Yeah. So, and I think you're going to see some of those situations definitely as a result of this issue. I mean, like I mentioned, there are some suppliers that right now their employees are making more money being on unemployment okay, which is a sad state of affairs here in the US today, but it is a fact, okay? So how do you motivate those people to come back to work? You know, can you motivate them before the unemployment runs out? You know, well, you can't motivate them if there's not a safe working environment, because that's the one thing they're going to argue and say, hey, this is why I'm staying home. So, you know, again, I think it's a great point you bring up, but I don't see that as much of an issue. Now, I do think you have to acknowledge social distancing in manufacturing facilities is going to raise costs, okay? It's going to raise the cost of operating. So you're going to have to see other inefficiencies come some other ways. This is something that these companies are going to have to deal with. But, you know, it's a delicate balance between labor, you know, working conditions, pay. All of this is going to be sorted out here over the next 6-8 weeks.
So just sort of a final question, Paul. If this were December and we were looking back, where would the industry be some months from now?
Well, I think what you're going to be is you're going to be in a situation where you've had a number of companies that have gone into bankruptcy. You've had a number of healthy companies have seen this as a huge opportunity, okay, to be able to take advantage of weak competitors, to consolidate segments of the market, to segment or to basically consolidate around vehicle domains. I think you're going to see a lot of that. You're going to see a reprioritization for all companies, from the OEMs as far as what is their technologies that are critical going forward. That's going to work its way through all levels of the supply base. So you're going to see this reprioritization, and then you're going to see long-term changes in, you know, the work environment. The move from global to local, I think, is a trend. You're going to continue to see these structural changes. You're going to see OEMs doubling down on big bets. You know, EV could be one of them. Autonomy could be another. Connected definitely will be. So I think when we step back and we'll look, we'll see how did organizations make these significant decisions that have critical, you know, impact as far as what the industry looks like at the second half of the decade. And I think that will start to become crystal clear as a result of the decisions that are made.
Paul, I wanted to grab one more question, if I could. You know, so while everyone is trying to figure out how to get things restarted, make sure they have the financing, make sure they're doing the scenario planning for all the bad things that might happen, they also have to address the USMCA coming into force in July. Is that, do suppliers even have the bandwidth to deal with that? And do you see changes in the shape of the supply base? You just mentioned the global to local. Are we going to see a wave of investment in suppliers in the US or Canada? Or is it maybe just enough to make up for what we're losing by the volumes being down 20-30%?
I think what you're going to see is, you know, traditionally, if you look back at what the focus of suppliers have been over the past 10 years, the focus of supplier organizations, purchasing organizations, to be honest, whether it's the supplier level or the OEM level, it has been about cost reduction. I think what we're moving into is a phase of far more strategic insights to where that supply base is going. Okay, so like we started the show with, the structural changes that are taking place, you have organizations like GM, Daimler, VW, who are starting the end of the development of the internal combustion engine. That will have an impact. Who survives in that supply base? Who is going to transition with those OEMs to other areas of the vehicle? These are significant strategic decisions for supply bases to be making. You add on top of that the move from this global to local, Again, you give supply-based managers, VPs of purchasing, you give them a tremendous amount of workload beyond just trying to improve the operating costs of a vehicle or the components they supply to the OEMs. So I think we are on the verge of a huge fundamental shift in the type of work that's done by these purchasing organizations and supply chain management organizations. And whether it's my dear friend Carl Smiley, who is leading the supply chain management activities at FCA, or if it's, the lower tiers, they're all going to be dealing with these type of strategic issues that I think are going to be very different than what they've traditionally looked at over the past 10, 15 years.
Thanks.
Real good. With that, I think it is time to wrap up the show. Paul Eichenberg, thanks so much for coming back on.
Hey,
You've given us a lot of things to think about here.
All right.
Jamie, good having you on. Good seeing you.
Good to see you, John. Gary, nice to meet you, Paul.
And Gary, let's keep on doing this.
So thanks, guys. Appreciate it very much.
Okay. Thanks, everyone.
AutoLine After Hours is brought to you by Bridgestone Tires. Your journey, our passion.
Visit our website, Autoline.tv, where you can watch us live Thursday afternoons. Get your daily fix with Autoline Daily and in-depth analysis and interviews with Autoline This Week. There's all that and much more at Autoline.tv.